Welcome back. I am Samuel Olatayo Ajayi of the Department of Banking and Finance in the Prince Abubakar from the Prince Abubakar Audu University, Kogi State, Nigeria. In this class, we shall be looking at financial control and quality control measure, deployment of financial control and quality control measures using budget variance scenarios. Okay, and the scenario goes like this. You're a financial control officer at Eagle Bank. The bank has just published its quarterly budget versus actual reports. The management is concerned because the budget for the marketing and advertising department is significantly high. Furthermore, the internal audit system has flagged a list of duplicated vendor payments. So here, what we have here are actually the financials, both the actual budget and the budget itself and the actual outcome, the actual value across cost centers. And when we check, we have 10 of them. Of course, this is a typical expenses head that one will find in an income statement. Okay. Now, what are the expectations? What are the expectations? There are certain outcomes that is expected. Of course, one would here we have the budget. We have the actual budget, and we have the variance. We have the percentage variance. We have the proposed budget, of course. While the head of marketing is saying that the performance of the financial performance of marketing and advertising, the actual amount was as a result of aggressive advertising campaigns, and he was arguing that has stimulated profit. But the chief finance officer, in his judgment, opined a 10% cut, a 10% reduction in the actual budget. All right. And the position of the chief finance officer, the opinion of the chief finance officer talking about cut by 10% as suggested, was upheld by the CEO. Okay, so in this case, we just want to run a variance analysis quickly. Here, we'll be looking at the variance will be actual minus budgeted amount. So this is the actual amount minus budgeted amount. Equals actual amount minus budgeted amount. Okay, then the percentage variance becomes equals actual amount minus budgeted amount. Actual amount minus budgeted amount. Okay, then here the percentage variance equals the variance divided by the budgeted amount. Okay, then proposed budget is talking about 10% cut on the budgeted amount. So that is equals to the budgeted amount, okay, minus 10% off, that's times. You remember that off in basic fraction is times. 10% off the budgeted amount, bracket close. So it's as good as saying that 45 million minus 10% of 45 million in this case. All right, so we click on enter. Then, so while the budgeted amount is 45 million, the CFO suggests that they should rather reduce it to 40.5 as against the opinion of the head of marketing. Okay, recall that the head of marketing was arguing for his own unit, and it was his argument that sent the spike that triggered the conclusion of reduction of the budget estimates. All right, so then on status, to check whether it is favorable or not, there is a condition. Let's put equals if the actual amount, if it exceeds the budgeted amount, because what we are discussing here is expenses. So when we are spending more than we budgeted, that is not favorable. All right, so we are saying that if this is greater than this, return as what? If this is greater than this, return as what? Unfavorable. Comma. Otherwise, return as favorable. check the iteration. We are simply saying that if the actual, if it is greater than the budgeted, return it as unfavorable. But if the reverse is the case, return it as favorable. So why is this favorable? If you check, you will discover that it is lower than. Then with all this said, we do a drawdown, and there we fill in our details. Now when you do a check, you will discover that for the security service is unfavorable. Okay, what is the actual? 1.9. A 30% reduction will mean that a proposed 10% reduction would bring it to 1.62. It will still be unfavorable. Then let us go and check the head of marketing and advertising. Marketing and advertising was marketing and advertising. When we do a check, it is unfavorable. But let us do a check on it. You will observe that the budgeted amount is 8 million naira. Okay, and the proposed one is talking of 7.2. It will still be what? Unfavorable. Unfavorable. So you would expect that the proposed budget will further widen the gap, further increase the assessment of non-performance across on the cost centers that were not performing well previously. Then the second aspect looks at, we want to quickly look at how to check for duplicated payments using conditional formatting. Okay, in that case, let us check for invoice numbers that are duplicated. Just select the column, go to home, go to conditional formatting, highlight sales rule, then duplicate values. So when we check, you realize that every content that are in red are all duplicated. Then let's come here, the same thing. Let's go home, conditional formatting, highlight sales rules, duplicate values. Okay, every content in red points to what? Duplicate values. So if you go and check, you realize that there is duplication of 450,000, but it does not amount to error, because when you check, you will also discover that there are two separate transactions. Transaction ID T001 and transaction ID T020. So away from that, we can now pick 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 or so. So every content for invoice, the content on red are duplicated. On payment, the content on red are duplicated. Okay, on transaction ID, conditional formatting, home, let's pick on duplicate values. Highlight cell rules, duplicate values. Okay, can you see the transaction ID is pointing to the fact that there is no duplication. So that in itself affirms control weakness on the vendor payment identification system, because if it is a transaction ID, then it suggests that the transaction ID should be distinct, the invoice number should be distinct. Okay, but in this case, there is never a case of duplication on transaction ID, but we are seeing a case of duplication on invoice number. So it means that some invoices were posted more than twice and erroneously so. All right, then the last leg of engagement is to use COUNTIF for verification in either payment or uh, or uh, review of invoice number or even vendor name. So in this case, we are to use COUNTIF function. So let's do a COUNTIF COUNTIF the payment amount. So in that case, we select range. COUNTIF the payment amount is greater than 50,000. So what are we saying here? We did a count whether it is greater than 50,000, and we discovered that yes, across 20 payment transactions, there is none that was not greater than 50,000 naira. Then let us see how about above 200,000 naira from the range of item. 14 of them were above 200,000 naira. Then the duplicated, let's say we now want to do COUNTIF for an isolated event. Okay, so COUNTIF for an isolated event. Let's say we want to do a count for this particular invoice number. So here, what we have here is, instead of greater than, let us put this particular invoice number. Okay, then okay, then instead of U to U20, let us change to this, because the section we are dealing with is actually the invoice number section. Okay, and not payment. What we are counting, what we are trying to verify isn't payment. Okay, so when you count, you can see it's pointing to the fact that invoice number 001 appears what, twice, and when you do your check properly, you will see it 2 times. Are we together? So that explains how we can use we can do variance analysis on financial statements using application of computer, and how we can check, detect error using Excel add-ins. Thank you. We shall meet again in the next class.